Good morning and happy Thursday. What an intense last week. What an intense last year. I don't know. The whole year has been.
It's been intense. It's been a roller coaster.
It's been a roller coaster. It's been a roller coaster. So Megan's got some surprising numbers. I'm going to talk a little bit what I saw on the economic side behind those numbers. We're also going to talk about the Fed meeting minutes, what's happening with interest rates, can they still go higher? And all the good things. We've got even the Fed map as far as what our expectations are for the Fed rate. So the Feds are supposed to raise the Fed rate again on November 2nd. We've been doing a lot of talking about the fact that if you're diversifying your portfolio, you're pulling it out of stocks, you're going to cash, you might want to look at a one-year treasury right about now, or certainly after the November 2nd. So all of those things are the things that we're talking about, the things that you can then turn around and go to your clients expressing just an understanding of what's happening in the market, because that's why they're looking to you. They're looking to you for advice, right? Direction, a bit of a path. So here, in light of that, that's where my quote went this morning. Success isn't just about what you accomplish in your life. It's about what you inspire others to do. This is our period of time to be inspirational. It might not be our period of time to be transactional. And there's less transactions going on, although you had a good week.
It was a crazy week for me.
So it might be a fact of less transactions for you. I'm hearing from different agents. It might be a time where you're getting hyper-focused on other things, but I would say with all things, education and a focus on inspiration is really where we go to continue to stay relevant with our clients going into this new year as we continue to be turbulent to unwind what the Fed has done and is in the process of doing. Yes.
Yeah, it's been kind of a nutty week. I went through and I triple checked my numbers, but this last weekend there was a really big pop of activity. And so I'd be curious to hear in the comments how the weekend was for you guys, because we ended up having a huge jump in the number of units that went under contract, and it showed up in my numbers for this week and in my title orders coming in. So thank you for those of you that sent title business to me this week. I certainly appreciate it a lot, but I was really surprised to see what's happened with some of our inventory. Usually as we go into September and October, we end up starting to see people purge and withdraw their listings from the market. We did see a pickup in those withdrawn transactions. Expireds didn't quite peel off the way that I would expect them to at this point in the year. Usually people are starting to say, the holidays are coming around. Do I really want to show my house with holiday decorations up on my house and getting ready for that? And also just sliding into the holiday season where it's busy for you anyways. People start to pull their listings from market, but we've had people hang in there this year. We aren't seeing quite the same level of expired and purged listings from the market this year that we've typically seen. So inventory remains high. The last time that we saw inventory this high was back in 2019. And so I'd liken this market a lot to 2019 if you're trying to figure out how your home is going to sell this year. And as you recall, back in 2019, for the first half of the year, interest rates were higher. Right. And so it went from a 3% interest rate to a 4.5% interest rate. And so
what I wouldn't do for 4.5 right now.
Oh no, right? I know. And we all thought the sky was falling in 2019. We're like, oh no, the market's over. And then rates took a turn and they dipped again as we went into COVID. But it's been interesting to see what's happened. And as I go through and I start to think about how I'm going to lay out my projections for next year, I don't know that I'm going to use data from 2020 and 2021 because the data is just so skewed with those low interest rates that I might go back to looking at my trend maps for 2013 through 2019, where it looks like we're on a playing field that's very similar to those years. That's more of our normal market based off of the last 10 years in real estate in Denver.
This week compared to this week in 2019, what is our inventory the same? Because we've been trailing under 2019 this whole time.
Yes.
Yeah.
So this last week for the same week 1 year ago, we're up in inventory pretty significantly by about 100%.
Okay.
Yeah.
Then 2019 though.
Then 2019, I don't know what it was for 20. I wasn't tracking it weekly for 2019.
Okay. So compared to 20. Yes.
Yeah.
Yeah. Year over year, but as we head towards the 2019, I understand that.
Yeah. Oh, we're getting bad sound.
Oh no.
A lot of feedback.
Okay.
Give us a second to try and figure it out.
When I talk.
Hold on, guys, just a sec. We're going to figure out what's going on with the audio.
What's this? All right. Give us a clue. Is that any better? Sorry about that. Your sound is good, just on Nicole's. All right, I think it's because the mic was so far away from us. I brought it in closer. It is the road, so I apologize, guys. All right, can somebody type in, how are you feeling about the sound now? All right, it's good now, better. All right, that's what it was. It's this guy right here. See that? That was too far away. Like, what is that thing?
Well, let's go ahead and hop into the numbers now that we've got
Yes.
that all fixed up. Let's see, make sure I'm doing this right here. Yeah, I think we got that right. Let me know if that doesn't look right to you guys, or if you're seeing my notes screen. Looking at the Metro Denver market review, going into this last week, we actually saw, and so here's your heat map. You can see ever so slightly that we had that number heat up just a little bit across the bottom, specifically with pending transactions. I was talking with Nicole yesterday as I was going through and pulling out the numbers, but it looked like there was a jump in pending transaction count by a big significant amount just over this last week. And if rates had dipped going into this last week or not, so that people were buying on the dips, with this last weekend really heated up. As we look at what happened with our average daily active count, our average daily active count came up to about 7,000 active units, which is up 1.2% from the previous week. Again, what I'm looking for at this point is more expireds and withdrawn transactions. And withdrawn transactions took a jump this last week. They were up by 70% over the previous week. We had 435 people choose to withdraw their listing from the market. We had about 328 expire. And usually the way that you guys write your contracts, you set your listings to expire at the end of the month.
Mhm.
So at the end of the month, I tend to get a larger purge that goes through at the end of the month. So that would have been reflected 2 weeks ago, or I'm sorry, last week when I did the numbers for expired. And we did see a few more expired listings, but not nearly as many as what I would typically expect to see for the end of September. Pending units, though, was the big story. And we put 1,409 units under contract last week, which was an increase of 56.4%. So everyone was out buying properties this last weekend, which was really interesting. And it drove our month supply of inventory from 1.8 months worth of inventory down to 1.1 months worth of inventory. So that was a huge drop by about 35% in our month supply of inventory. And that puts us back down to, for every one buyer in the market, they have 1.1 homes to choose from. And so the only thing that we can attune that to is during the middle of the week last week, interest rates were lower. So we're curious if people were buying during that time when interest rates were lower over the last weekend, where people were waiting for those dips to start happening and they locked in those rates at that lower rate. But that was really interesting to see this number come back down to 1.1 months worth of inventory and such a jump in that pending transaction count.
And let's talk about that just for a second, since our microphone wasn't working as well, because we were talking about that before you started your slide deck. You know, here you're seeing this, we're not expecting it. The last couple of weeks, we were seeing inventory increasing, right?
Mhm.
Interest rates have been very volatile. They had topped over 7.25, shocked everyone as they had reached those levels. We did see a little bit of a dip, but not dramatically. It went to like 6.625 or 6.75. I mean, it was barely under 7, yet you know, here we are, realtor.com had said the best time to buy was the end of September, beginning of November. Adam just put out a report showing the best month to buy is in October. You know, so that stack of inventory that had come in for a couple of weeks, are we now seeing that buyers are maybe settling into the 7? Maybe they're just taking it when they can get it in the 6s.
Maybe they're just taking it when they can get it in the 6s, because it's again, we're expecting 2 more interest rate hikes. And so maybe that's acting as a catalyst in the market so that people can get in before those interest rates possibly go up even more. Because even though there isn't a direct correlation between the Fed rate and what happens with the 30-year fixed loan, there is some sort of correlation that happens between the two, where oftentimes that 30-year fixed will go up. And so maybe it's acting as a catalyst in the market, getting people off the fence to get them out there to go and buy something. But this last weekend was really sensational in the fact that we got 1,409 units under contract. I mean, that number is more like a late summer number than it is a fall number.
Yeah. And you track, as you had noted, because I asked you specifically the dates, you track Wednesday through Tuesday.
I track Wednesday to Tuesday each week.
Okay.
So that I can catch the whole weekend of activity. So the odds of selling actually increased this last week too. And so the odds of selling jumped up to 56.1% odds of selling. So that was a nice little bump. We dropped down to 49%, which is back where we were pre-COVID, and very much so like what we had in 2019 when interest rates were higher as well. But the odds of selling is where I take into account basically all of the available homes for sale versus those that go under contract and or close within the same week. And I project that forward for a 4-week period of time. So the odds of selling actually increased greatly from 49% up to 56.1% just this last week. In order to create a market and balance with a 6-month supply of inventory, we need to have about 36,000 available homes for sale based off of what went under contract last week. I'll be curious to see if we continue to see this trend of increased listings going under contract going into this next weekend or not. It's going to be interesting as we get into the back part of October because we've got all the Halloween parties that are starting to happen and more distraction. Like we've got homecoming this week for school. And so people are more distracted rather than going out and looking at homes. We've got homecoming season going on. So we'll be at Fall Festival at Denver Christian all day Friday and hanging out with all of that and doing all the fun boat races with the kids across the pond in their cardboard boxes. But 19.1% of inventory is what we had to offset demand this week. We're still not concerned with the market and correction, but it really came down. It was at 30% of balance. Now we're at 19.1% of balance. And so I'm really curious to see if this is going to happen again this weekend.
Because you didn't see the expireds coming off. You didn't people withdrawing their
withdrawals ended up going up, but our overall active inventory remained relatively flat. It was up by 1.2% this week. So it remained relatively flat. So there wasn't a huge change in that. It looks like some of the inventory that was aging is now being pulled off the market. And so, or going under contract, average days on market was up. And so again, it's just interesting to see that we had that huge sudden wave of units going under contract this last weekend. We're still not concerned about a market going into a correction phase where we expect to see home prices fall significantly. I was thinking about this, and I think it's going to be really hard for us to achieve those same average sales prices going into January and February next year. I think that we're going to have negative appreciation for January and February just because we were so off the charts with what happened in 2021. But I think that it's going to pick up and we're going to see more of that. It was interesting. I put out the appreciation maps by zip code this week. You can get that in the download that I'll send out later today, but it shows the appreciation through Q3 for all of the zip codes that I track in Metro Denver. I think there are 120 on that sheet that I look at. But what was interesting to see was that looking back at 2019, if we're comparing what's happening and trying to project forward in 2019, so far in 2023, we've had 12.3% appreciation when we look at it year to date. But when we look at just 2019's numbers, there was only 2.3% appreciation during 2019. So I'm thinking that our appreciation is going to be drastically lower going into 2023 as we still have some of that market correction going on if interest rates remain high. I don't know that we're going to have the rapid start to the year. And so timing those listings, if you're trying to figure out when a good time to get those listings back on market based on data from 2013 through 2019, when I put together that heat map for you, which is actually this guy back here, I think that we're going to see a lot more stuff like this where we really see it pick up in March, April, and May. And so this is again, looking at just 2013 through 2019. And then I started tracking it on a weekly basis. So we went into 2020 just to try and keep up with what was happening. But I think we're really going to look a lot more like 2019 going into that time. Showings remained relatively the same. We had 11,500 total showings that were set last week. So about 1.6 shows per property per week. I'm still getting a lot of calls on Monday. So thank you for reaching out to me to get that showing report for your zip code and your price range for how many showings you should have got on that property. Great report that you can pull from Showing Time underneath reports, target market analysis, super simple one to go in and play with. I'm still working on getting Broker Bay showings in here. Again, it's about 10% of the listings are in Broker Bay right now. So I'm missing some of that showing data. So I might add one extra showing to this number in order to offset and figure out what's happening in Broker Bay. Shows to pending, it was 8 shows to contract this last week. So people looked at fewer homes this last week. Normally that number has been hovering around 12 or 13 showings to go under contract. This week it was 8 showings to go under contract. Again, we'll see if this number continues to hold true and if we continue to see as many units going under contract. And I'm just wondering if this is kind of a blip on the radar for this last week where we just had a really good week. My
gut's telling me it's like I don't want to say it's a singular week blip, but maybe a couple week blip. But I mean, it really could be an opportunity to get your buyers out this next weekend. If you have a seller who is wavering, maybe still get them on the market.
Yeah.
If they were thinking about doing that this weekend.
The odds of selling, interestingly enough, actually tends to increase as we go into October, November, and December.
Right.
They're at their lowest in September, typically, when we have the most amount of inventory and the fewest amount of and fewer buyers on the market. And so the odds of selling is really in their favor. And I would highly suggest that you list a property right now, especially if that seller is intending to buy in Metro Denver. If they're a contingent transaction, now's a great time to get in the market because you're going to have more negotiating power to get that contingent offer under contract.
Right. Makes sense.
So it was only 8 showings to go under contract this last week. That number dropped way down. Looking at median days on market for units that went under contract last week, it was up just a little bit. We were at 20 median days on market. And so it's just a little bit longer. We're hovering around this 17 to 20 mark now for about the last 6 weeks for median days on market. We're now up to 49.9% of all the homes that went under contract last week made a price reduction. And so we're almost at that tipping point where half of the homes are making price reductions to go under contract. That number tends to grow as we get into the later part of the year. So we could see that number tip over that 50% mark. I'm getting a lot of questions about price reductions and concessions.
Yep.
Do I do one or not the other? And in order to get the concession out there, you have to do a price reduction in order for it to reping all of the additional websites. If you offer a seller concession and you just type that into public remarks, it doesn't necessarily update on all of the consumer websites. You also have to make a price reduction. So in about 25% of the cases, we're seeing a price reduction coupled with some sort of seller concession or buy down that's being offered on those properties. Looking at the size of the price reduction, I need to rescale this graph so that you can actually see the numbers, but it was about a 6.9% price reduction for all prices last week, or about $50,000 off of the original asking price.
I've had a lot of conversations about that right now. So 6.9 is the general, the average price reduction that you're seeing in this market, right? And so it was so interesting because I did have a very in-depth conversation at the very end of the day yesterday, talking about a buyer who had gotten an opportunity to buy down his rate, but then he also wanted a price reduction on top of it because he felt that he wanted to get the deal because he knew that prices were being reduced. And it's such a hard place right now because buyers were beaten up for so long that now they want it all.
I know.
Right? And trying to negotiate and having that number in front of you to go, okay, but interest rates are here. It is a relationship of prices coming down. And it's going to take a while for that to correct. You still have a great deal and a lower monthly payment. Knowing these numbers really helps in having those negotiations.
It sure does. And I get a lot of questions about that as people are getting ready to write offers. They say, hey, I'm getting ready to write an offer. Property's been on the market for 3 weeks. What are you seeing in terms of price reductions at this point? And so I'm able to go through and look back at the data and say what types of price reductions people are getting. Or I can go back and look at, I have a graph in the monthly reports that tracks days on market versus the original to close price ratio, how much of a discount you can get based off of how long that property has been on the market. And so we're seeing that happen a lot right now. Lots of good questions about that. For the up to $500,000 price mark, looking at what happened with pending transactions, we put 621 units under contract this last week, or 76.9% increase just week over week in this market. And so we actually dropped down to 0.7 months worth of inventory, back from the 1.1 months worth of inventory that we had earlier. Withdrawn listings were up. They were up 134. There were 134 units that were withdrawn from the market. Expireds were up 95, which is down 1% from the previous week. Our average daily active count kind of hung in there at about a 3.7% increase in our average daily active count. We should start to see that number purge a little bit more. The odds of selling for the under $500,000 mark popped back up. It was at 67.6%, up from the 58.8% that we saw just the week prior. Looking at where we should be for a balanced market in this under $500,000 market, we should be closer to about 16,000 total units available for sale based off of what went under contracts. We only have 11.1% of the inventory required to offset demand. Looking at showings, there were about 2.3 shows per property per week in this particular price range for up to $500,000. We had about 7 shows to contract in this market. And so again, our shows to contract really came down. Normally that number is hovering around 12 or 13. And I'm probably going to hang my hat on that 12 or 13 number rather than that 7 number. My gut that's really telling me that this is kind of a blippy week.
Yeah.
I don't know that this is going to be a trend that continues going forward where we're going to have as many units going under contract.
Let's pray for just a couple of weekends.
I'd be thrilled with just a couple of weekends because we had a really slow start to October.
Yes.
And I'm looking at my title orders coming in and I'm like, man, I'm really missing a lot. And I've got the Colorado Springs team, if they're watching right now, they're hot on my trail right now. To be the top rep for First American, and it's kind of killing me because normally I have a bit more of a margin on there, and I'm like I'm struggling right now, so I need all of your title orders so that I can stay number one. 17 median days on market for those that are up to $500,000. 48.6% reduced their price this last week for those units that went under contract, and the size of the price reduction was about a 6.4% price reduction, or about $28,000 off of the original price. Looking at the $500,000 to $1 million mark, this market didn't quite see the same jump in pending transactions. This is our most interest rate sensitive price bracket, where about 90% of them require financing to get into a house, but we had 668 units go under contract in this $500,000 to $1 million mark. Our average daily active count remained basically the same at about 4,200 active daily units. We did see more withdrawn transactions. 247 of those units withdrew from the market. New listings were down this last week by 18.6%. So we didn't have quite the same jump in new units coming to market, but our month's supply of inventory dropped from 2 months of inventory down to 1.5 months worth of inventory. So for every one buyer in the market, they have about 1.5 homes to choose from. This market really tightened up over this last weekend. The odds of selling came up just slightly to 50.7%, up from the 46.2% that we saw just the week prior. In this market, we would need to have about 17,000 total units available for sale, or we're sitting at about 24.4% of balance. So this market didn't quite tighten up like what we saw for the under $500,000 market. We were looking at about 1.4 shows per property per week. When we factor in Broker Bay, we could call it 2 shows per property per week, probably just with that little margin of error that's in there. Shows to contract was 9 this last week. Again, I just really think this is a blippy week, but it's been hovering more so around 12 to 13 showings to go under contract for about the last 2 months or so. We had 22 median days on market for homes that were between 500 to $1 million. We did see that 53.3% of what went under contract last week had at least one price reduction, and those price reductions are larger. We're looking at about a 6.9% price reduction, or about $51,000 off of the original asking price in this price range. 1 to 1.5 million. This market actually heated up a little bit more as well. We ended up dropping from 2.6 months worth of inventory down to 1.5 months worth of inventory. Our pending transaction count came up by 73.5% this last week. Our average daily active count was about 548, so it drove down our predictive month supply of inventory, where I'm comparing those active units versus those that are going under contract in that given week to kind of figure out which way that number is trailing. So sitting at 1.5 months worth of inventory right now. The odds of selling increased from 43% up to about 50%, which is still better than where we were back even just after COVID. And so it's still looking really good. This market hasn't really fluctuated like the lower priced markets have in light of higher interest rates. These people are pulling money from their stock accounts and they're buying real estate right now. And so it's interesting to see how people are kind of shifting their money around, but they're buying real estate at higher price points.
I'm going to jump in really quickly. If you wait until the end of the second half, I've got a program for these guys who are pulling out money, but maybe don't want to pull out all their money. Now, I get it. The stock market is kind of tumultuous right now. It's a little risky. However, if you've got assets, we've got a new program that I want to share with you. And this is really going to help these guys.
Good. Just scrolling through questions really quick.
Yeah.
Quick question. How many are currently back on market with the 1,400 homes that went under contract? Did we fill back in with new listings, or we had a lower number of homes on market right now? So average days on, or average inventory stayed at around 7,200 active listings. It was only up by 1 or 2% this last week. And so new units coming to market, we're not seeing as many new units make their way to market. We saw more units withdraw or expire this week. And so for units, for units that came back on market, the fallout rate this last week was about 10%. So it went up by about 1%. And so we did see a few more units that fell out of contract and come back on the market. And so I answered the odds of selling while listed during that first week. It's actually projected forward for about a 30-day period of time. I multiply that by a factor of 4.35, which is how many weeks are in a month. And so I project it forward for that next 30-day period. The way that and the question is, how do you determine percentage of homes needed for a balanced market? I bake the number of units that went under contract that week, multiply that times 4.35. So I get a month worth of pending transactions. And then I multiply that times 6. Multiplying that times 6 would give me a 6-month supply of inventory.
And we're seeing a lot of conversations about, because it feels more like a buyer's market, but the numbers aren't showing it to be balanced or buyers.
No, and
neither.
We thought that 2013 through 2019 was really on fire, and we thought that those were great years, and those were all considered to be sellers markets with less than 2 months worth of inventory. And so now we're just going from 120 degrees down to 80 degrees at this point.
It's feeling comfortable.
Yeah.
Well, a little scary, but the temperature's comfortable.
It is, but we adjusted to being so hot for so long for those 2-year periods that anything slower than that is going to feel like we've shifted to a buyer's market. We're truly not in a buyer's market. We have trended towards balance a little bit more than what we had for the last 2 years in a row, but using these last 2 years of data doesn't really make sense anymore because they were so insane with having interest rates down in the 2s and the 3s. In this market, again, for 1 to 1.5 million, we'd need to have about 3,300 units to go into a balanced market. So we only have 16.5% of the inventory required to offset demand. We were looking at about 1.6 shows per property per week. This week, it was 11 showings to go under contract. So that number hasn't shifted very much. It was about 10.6. That number had been trailing up for the last couple of weeks. So it's taking fewer showings to go under contract, which is encouraging. Median days on market for this segment was 14 median days on market, which was down 6.7% from that last week. We'd really watched inventory age from the end of June up until about Labor Day weekend. Labor Day weekend, we had 28 median days on market, and it's come down ever since then. And so it's a great time to be in the market as a seller right now for this $1 to $1.5 million mark. Only 29.6% of them made price reductions, and the average price reduction was 9.2%, or about $122,000 off of their original asking price. For the 1.5 to $2 million mark, we'll take a look and see where these numbers shook out. We had 25 units go under contract this last week with about 211 average daily active units. So our month supply of inventory came down to 1.9 months worth of inventory. We had been trending towards 2.5 to 3 months worth of inventory for the last couple of weeks. So it really came down again this week. The odds of selling were 46.7%, which was up 4.2% from just that last week. Looking at where we should be for balance, looking at our market and balance, we're at 16.2% of the inventory required to offset demand. We should have about 1,300 available units for sale in this particular market. Shows per property, we only got about 1 show per property per week in this $1.5 to $2 million price point, and it was 9.6 showings should put you under contract. In this price range, we've been hovering closer to, it's been bouncing between 13 and 16 showings to go under contract for the weeks prior to that. So it really came down this last week. Median days on market was 25.5 showings to go under contract, or days on market for this $1.5 to $2 million price point. Half of the listings that went under contract last week reduced their price, and their average price reduction was about 11.6%. And so again, interesting week overall when I look at those numbers. I mean, I had a fantastic week. I was really thrilled to see that. And I really hope that it continues going through this week, because October started out really slow, but people might have bought on the dip when interest rates were a little bit lower last week. And so we'll take a look and see what Nicole has to say about what's happening with rates right now. And so kind of interesting to see a lot of this.
I think you covered the odds of selling
that one.
Okay, so all of those. We're going to look at average interest rates last week, and then the ARMs. I mean, we're definitely seeing the 5 and 7 year ARM. We can send out kind of what the average rates are for that. What did I just read? 15% of all the apps that came out last week were ARMs, which makes sense. A lot of people are thinking that the rate isn't going to last very long and that we're going to refinance. I'm actually going to show you a chart too that talks about why buyers are having to pay discount points really for almost any rate right now. So there's a lot of risk in the secondary market that's going to impact how high our interest rates go, because a lot of people are asking, well, how high can rates go? And I would have said, I did say that I didn't see them going to 7. I didn't really see them going above 6, but so much of the market has now been adjusted due to the Fed's push towards higher interest rates. I'm going to show you where they're looking now at 5% is where they're taking the Fed rate. That kind of fear is going to riddle itself back through the market. We're seeing that whenever the Fed meeting minutes come out, or inflation numbers just came out this morning, and what that does to our interest rates into the stock market. The wealth effect is going backwards. We were feeling an incredible wealth effect over the last 2 years that were really allowing people to push a little bit outside their comfort zone, maybe buy that home that was $50,000, $100,000 over what their budget had originally been. But due to the low interest rates, or due to that wealth effect and how they felt in the stock market, they were willing to take that plunge. Now we're seeing the reversal of that happening a little bit more of a realistic look onto how secure is my job? What are my wages looking like? How am I feeling as far as my wealth in the stock market or bonds or other investments? Do I own any other properties? Do I have income coming in? All of those things are being taken under consideration. All of that to say, though, every market has a buyer. Every market has a buyer. And we're seeing that because we're seeing the buyers come out like crazy with any little dip, right? They're just waiting.
They're just waiting it out.
Even if I can get 6.75 versus 7.25, I mean, is that a big enough difference? Does that really make a big enough difference? I was sitting down with a client of mine that I adore, who has been a client for many years in many homes. And we talked about the fact that if she's selling a $900,000 home and buying a $900,000 home, and theoretically would have approximately the same interest, or I'm sorry, the same loan amount, her interest rate, we've seen it going up 4%, right? I mean, it went from 3% to 7%. And that's going to impact about $1,100 a month. So just to trade homes right now, she's trying to decide, is it worth $1,100 to me to have the exact same loan amount? And then looking at, do I want to live where I live right now? Do I want to have that change of lifestyle? Can I afford it? Wages have been going up, all of that. It's conversations, but they're still buyers and they're still doing it, right?
Yep.
So let's jump in. I'm going to share my screen and get through kind of what the Fed's doing. What are we seeing? All right, share. All right. So as we're, just to reiterate, since I had the microphone was a little bit far away from us in the beginning, I feel like maybe it's not you, maybe it's just me. I'm always learning something about the audio. I feel like every single time. But the crackling was my dog Moose, who was going to town on his pillow. So the crackling had nothing to do with our audio. I'm just going to leave that there. Moose comes to work with me a lot. And you know what? I love having my pets. So there you go. But this is where we started, right? And so to reiterate, since it was a little crackly, keeping your focus on where it should be right now, because maybe it's not in pushing buyers to buy or even pushing sellers to sell, but simply supporting them so that you are able to inspire them to do what they need to do for their families, right? For their wealth, for their security, for their stability. And right now might not be the time, but for the people that it is, they're getting a great deal. We're seeing home prices come down. We're seeing the buy downs happening from seller credits. We're seeing inspection items being repaired. We're seeing a lot of negotiation opportunities for those homes, especially if they've been on the market, and buyers are feeling like they're taking a little bit of that power back that they had literally lost all of it over the last 2 years. So balanced, maybe not, but certainly seeing a little bit of favor. So Megan was talking about, well, what did we see last week that kind of drew this out? So this is what was happening with our 10-year. So this morning, we're having a battle at 4%. We're trying to go above it. We're not quite hanging on to going above it. The last time I checked, right before we went online, it was at 3.96. So it's really struggling, and that's kind of a level of resistance, which is good for all of us, because if it breaks 4, it will be a little bit before it stops again, and we could really see that impact higher interest rates. But we did see a nice little dip. It dropped It was hovering around 4. It dropped down to 3.6%, and now it's back up to 4. This is the 10-year. Remember, the 30-year fixed is usually historically trends 1.65 to 1.8% higher than this. Right now, we're seeing an even wider spread than that due to lender risk and the secondary market appetite, which we're going to talk about in just a minute. So we did see that little dip in rates. It certainly didn't drop down very far. It didn't drop down to 6.5, but it dropped down enough to take advantage of it. And then we saw those interest rates climb back above 7% as early as last Friday. So the lower rates was actually kind of on the Wednesday, Thursday timeline, not Friday, not Monday, as we head into this week. So we'll see where this week is going, because we did get the Fed meeting minutes. We got the CPI numbers that just came out this morning. Employment is still hanging on. Wage inflation is still hanging on. All of those things that are really not giving interest rates any reason to come back down yet. So when I talk about the secondary market, I just kind of want to show a visual of this. So when I loan somebody money, it's an origination that loan is then sold in the secondary market as a mortgage-backed securities, and it goes through the whole life cycle of a bond. It is a long-term bond. The 30-year fixed mortgage is tied most closely to the 10-year bond because of their duration, right? An arm is going to be tied to the lower, like the 2-year treasury bonds. So we're talking about the 10-year, and the interest rate, or the coupon rate for those, were most significantly being placed inside the 5% and the 5.5%. It doesn't quite exactly equal, because you figure if I get a mortgage for 7%, well, the lender takes a little bit, Fannie Freddie take a little bit, the investor pool takes a little bit. And by the time it's sold to an investor, it might land at being a 5% coupon rate on that bond. Like that might be the interest rate that I would look for if I was an investor purchasing bonds versus stocks, if that makes sense, right? So they're not going to equal. Everybody gets their tick on the way down. So, but I wanted to kind of show, it's just a visual that I think is astounding. So we lost 600 to 700 bips on the pricing simply from April. So we've seen interest rates go up 4% from 3% to 7%. And that is because the secondary market is losing value on these coupons. So this is also why, if a coupon is pricing out at anywhere from 99 to 96.7, when you think about par rates, as a real estate agent, that doesn't really need to mean a lot, but from a finance perspective, a par rate is 0. It simply means that nobody has to pay to get that rate, and you don't get any lender credit to get that rate. It's just par. This is your rate today kind of thing. Well, you want that on the secondary market, which is a different par, but you want that on the secondary market where you're selling those bonds for at least equal or more. Really, lenders want to sell, and there's money to be had on the secondary market, right? So originators earn an income here, like kind of on the front lines, and then the lenders take those bonds and they sell them on the secondary market for a profit. The profit is gone. In fact, if you're working with a lender that's not holding on to some of those mortgages, waiting for the market to turn, like OneTrust is, they're actually having to pay to sell them because they're discounted right now. So a lot of these 6.75, 7.25 are going into that 5.5 coupon rate, because there's really nothing selling much more above that. Although there is a 6% coupon rate, you're not seeing a lot of sales. So this is just showing the dramatic change that we've seen on the secondary market, which is providing risk to the lenders, which is why you're seeing lenders either consolidating right now. Some lenders are closing shop. A lot of lenders did loans literally for free or paid to do them just to keep volume coming in the door this last quarter. And they can't do it any longer. So they're going to scale back. They're going to lay off. Some will close and some will merge with other banks. That is happening right now because of this, because of the secondary market. We have an instrument that we want to sell, and that's not happening. So the Fed meeting minutes came out saying, although some interest sensitive categories of spending, i.e. housing, primarily housing and business fixed investments, those small businesses that are reinvesting in themselves typically do it because they take out a bank loan. Those bank loans are very expensive right now, so they're slowing down on their reinvesting. So although some interest sensitive categories of spending had already started to respond to the tightening of financial conditions, a sizable portion of economic activity had yet to display much response. So that was in the Fed meeting minutes that came out yesterday. Today, the inflation numbers came out showing pretty much that yes, although housing is slowing down dramatically, we are not seeing a lot of other things bring down the cost of inflation enough to see a change yet. Right. And so everything takes time. The Fed is actively increasing the Fed rate. It could be months before they see the results in these numbers. We're feeling it. We're certainly feeling it, but they're not seeing the results yet because the cost of a gallon of milk is still up and the cost of food is still up and the cost of medical care is still up. I mean, I heard something on the news this morning. He said, once you squeeze a tube of toothpaste and the toothpaste comes out, you can't get it back in.
Right.
So inflation is a little bit like squeezing the tube of toothpaste. Once that toothpaste comes out, it's really hard to get back in. It's going to be really hard to get wages reset. People will have to be laid off and then have to go look for another job. And those new jobs will have lower wages. So some of the way that wages are going to come down is going to be through the layoffs, which we're not seeing a lot of that yet. And some of the cost is simply because of the manufacturing, which I'm going to show the PPI numbers in a minute. But this 8.2% is just a smidge down from where it was as a comparison year over year, but it's actually up. It's up 0.4% month over month. The core was the big one. It was up 0.6% month over month. That strips out energy and food. It's energy that was keeping this down. A lot of things are still costing more, and it's going to take a little while. Transitory is like a forbidden word at this point. It is sustaining. So the categories of how that inflation is broken out, you see gas was definitely the thing that was holding that number down. If gasoline hadn't been reduced that much, we would have seen an even higher inflationary number. But many of the things that we do on a daily basis, and of course, everybody feels inflation a little differently, right? If you have an electric car, you're not going to get the benefits of gas being reduced. Or if you have high medical bills, you are going to be feeling that medical expense going up. So it really depends on what you do. See, if you don't eat fruits and vegetables, those junk eaters, you're actually feeling a little less inflation than the healthy eaters. So it is a matter of what you're spending your money on. And of course, it's on the strength of the dollar. So we're seeing some of that where we're seeing traveling is actually up. And of course, international travel is up because our dollar is so strong right now. So CPI numbers were up. Loretta, who is one of the Fed board members, she's the Cleveland Fed president, says we have not seen any progress on inflation. And so I think we need to bring interest rates up through this year and into next year. Monetary policy will need to become more restrictive in order to put inflation on a sustainable downward path. They're all talking about that. They were talking about for a minute, a couple of Fed meeting minutes ago, where they wanted to raise the Fed rate and then drop it back down again. Of course, you guys remember the stock market celebrated, our bond market celebrated, our interest rates went down. Now, the entire messaging from everybody is we're raising it and we're staying up. So we have another Fed increase in December, another one in February, and another one in March, very highly likely. In fact, really quickly, we're at 3.25 right now. All eyes are on raising that 0.5 point at the December meeting. We might see 0.75. It just depends because this came out right before the CPI numbers came out. And then we're seeing an additional increase in December heading up towards 450 is the highest probability. And then in February, seeing 475. So we're seeing those Fed rates are going to or expected to increase to 5%. Now, ouch. So what does that mean, right? So what does that mean? So HELOC interest rates are going to start going up. Anybody that's got variable HELOC interest rates should be calling their bank and asking what it would take to lock down the portion that's currently been variable. If you haven't done so already, and I've been warning about HELOCs for months now, if you haven't already locked that down or paid it down, you're going to see that interest only payment is going to go up each time they increase this. You also have some investment opportunities with the 1 year. I've already, talked about that. Peter and I are planning on putting some money that we have in cash into the 1 year. We might even do it again in February, depending on how high that goes. Our savings rates, interest rates are going up. hopefully having people save more than spend. That's the goal,
Mhm.
right?
Mhm.
So credit card interest rates are going up. Car loan interest rates are going up. Now, our long-term mortgage rates are going up because of the volatility in the market and the unknown aspect of what's happening and how hard the Fed is going to continue to push. It's also being impacted, as you guys know, based on the European markets and based on the European the European Central Bank, the ECB, going in and buying mortgage-backed securities, which they had been stopping doing that. The Fed has already stopped doing that, but they did a 2-week emergency buyback to stabilize. They were having pensions who were shorting the market, have some of those shorts being called. And when those were called, they were losing a lot of money for all of their employees and their pension accounts. So that rippled over to cause stress in our markets, right? So we're all moving kind of together. In fact, some of the ECB members were asking the Fed to slow down because they're also making it challenging over there. We are all one global financial economy at this point, but this is going to continue to impact that feeling of instability, hopefully, I say that tongue in cheek, hopefully pushing companies to lay off more employees, to scale back expenses, to weather the storm, walking into a recession. Once the recession hits, we're going to see that start to pull back. Inflation is going to drop, and so is the long-term 30-year fixed mortgage rates. Demand will then come back out, depending on those people who are stable enough, that still have their jobs, that still have money, that feel like they have a wealth effect, that are going to take advantage of the opportunities that the lower interest rates are going to have.
Mhm.
And then we're going to see prices stabilize and continue to go up.
Mhm.
Make sense?
Mhm.
That's a lot.
That's a lot. That's
Taking
a lot.
Yes.
It's a lot to go through.
All right. So the producer price index came out. It was actually up 0.4%, which really says the last 2 months we had seen, and this is just a month over month number, not a year over year number, but it's still saying we're not done yet, right? This PPI, the producer price index, is the cost of things back from the wholesale. So you're talking about manufacturing working its way through. So you have things that we're looking at as far as shipping, manufacturing, PPI, watching all of these. To see that go up 0.4% month over month is another indicator that the Fed still needs to push that Fed rate up aggressively and hold it there to impact the demand across the board. So that just came out this week as well. Initial jobless claims just came out this morning. Still low considering. I mean, I just wanted to show this chart just to show historically we're still low, but it did go up. It went up 9,000, and that was after a 29,000 increase last week. So we are starting to see some people are starting to get laid off as part of this whole thing where we'll see wages start to come down, which impacts inflation. Inflation, really some of the biggest numbers inside inflation are wages and rent.
Mhm.
And we're already starting to see rent slow down,
Mhm.
not enough yet to impact the CPI, but that is starting to happen. The mortgage purchase applications dropped. If you can kind of see the tail on this one, the blue line is the week over week numbers. This red that is kind of hiding the blue is a 4-week average. So it makes it a little bit hard to see, but it did drop. It is now 7% below the pandemic low. So it actually dropped only 2% this week, but it was just enough of a nudge where it is now officially below the pandemic low. Those mortgage purchase applications, people are heading into the holidays. What we're seeing is a lot of people that had been looking
Mhm.
are getting under contract.
Mhm.
So it's less about new people putting in loan applications and more of the older people. So really, I would tell you, go back through everybody who has not bought yet, just to give them an update. Not to pressure them into buying, of course, you know that, but to give them an update on what's happening in the market and how they have an opportunity right now that they might not have if they wait until next year, April. I don't know. None of us actually know, but I don't think we're going to see, and you kind of talked about this January and February, maybe seeing a price decline. I don't think we're going to see it right in January. I think we have to go through March with the Fed rate increases before we start to see this tip over. I think the first half of 2023 is going to look very different than the second half of 2023.
Yes.
Yeah.
Yeah, I agree.
All right. So Mike Franantoni, application volumes for both refinancing and home purchases declined, continue to fall further. The news that job growth and wage growth continued in September is positive for housing because higher incomes do support housing demand. However, right? It also pushed off the possibility of any near-term pivot from the Federal Reserve on its plans for additional rate hikes. We're going to continue to see those probably all the way through March. With that news, Goldman Sachs published a report talking about the fact that they were actually increasing their forecast with where the interest rates were going to be next year, right? A lot of people are counting on interest rates dropping next year. I know we've been talking about it. We were thinking as soon as we push in, I still think that we're going to see some dip in rates, but I've always said from what to what, if they continue to hover around 7.25 or even go to 7.5, do they go to 6.75, 6.5? I mean, that would be a drop. And we certainly saw that last week. A little bit of a drop goes a long way with getting people into homes. It's a perception of what is normal at that point. So people are getting used to the interest rates a little bit. Yes, let's go ahead and take advantage of it, knowing that at some point in the next couple of years, we are going to see some of that drop. You've got different economists that are saying different things. But they continue to go on that the supply and the built up equity continues to contain any real sense of price declines. So they talk about that a lot in this article, talking about the fact that that equity is going to continue to sustain it. I'm going to show you the foreclosure chart here in just a second. So they came out with their housing forecast. Remember, we'll have a copy of these PowerPoint presentation slides in the Agent Ignite Facebook group. If you want a copy of these slides to grab and put them on social media, use them in your conversations this week going into next Thursday as we update these slides. But mortgage applications, they're expecting them to drop to 1.5 trillion. So I want to just put that in perspective. They're a little bit lower from what the MBA says, but I want to hold on to that 1.5 trillion for just a minute. It's simply forecasting where we think the volume is going to go. And so MBA also came out with theirs and they're expecting 1.6, so a little bit higher. No, 1.6 for 2022. Sorry, the 1.5 was 2023. If I look at 2023, they're expecting 1.7. The Goldman Sachs is expecting a very low number for refinances because they're expecting the interest rate to remain high. MBA is thinking that that interest rate is going to go down slightly, landing this year at an average of 5.5. Remember, that's not where we land the year, but the average of all 12 months, and then 5% for next year, and then 4.4% for 2024. You're going to get a slightly higher, different number for Goldman Sachs. You answer, Freddie Mac, Fannie Mae, and NAR, all of them put out, and we'll start putting out this fourth quarter estimations for next year. So we'll continue watching this. But I grabbed all the numbers. I had Peter doing this at 5 o'clock this morning for you guys, showing that the mortgage originations are coming down from an extremely high number. But if I tail it to what happened pre-pandemic, yes, the unit counts are going to go down because home prices are going up. So it's going to take less units to get to the same volume, right? But we're going to continue to see. So this blue is the purchase originations, right? So it's not purchase sales. It's not your numbers yet. I'm looking at originations. It went up significantly. The refinances really went up. So this is a total. So the delta here is refinances. This is the purchases. It's going to come down is the expectation. And then we're slowly going to increase as home prices are expected to continue to go up. The market, people are going to still buy. People are still going to retire, downsize, upsize, graduate, have babies, get married. All of those things are going to continue to happen. Remember, we still have the largest population is like 31 years old. We still have a lot of people headed towards purchasing their first home. So as we're watching that, I pulled this off of the NAR numbers as far as the existing homes sold. They're expecting a drop from last year, of course, but we're still expecting right around that 6 million. So they're still talking about their volume. Their units are going to go down because prices are going up, but they're expecting to still hover, and which is still above what it was for the last decade.
Amazing.
So as real estate agents, as lenders, we have to continue focus on those clients that need and want our help. I have emails constantly. Nicole, how would you answer this? Nicole, what would you say to this? Somebody is talking about some outrageous thing with them banks imploding and everything's going to fall apart and we're going to lose 30% in value, all of those things. And I'll write out a script and I'll tell you exactly what to say. And then you end it with, and then I'll call you in 6 months, because some people you can't help. out of their fear for where they are right now. You can continue to educate, you can continue to present facts. Our market is still going to be good for those who are willing to work for it, right?
Well, and we're not day trading homes.
No.
And that's the thing that I keep going back to, is that you might lose money in the first year that you own your home. If we're in the multiple offer situation that we bought in earlier this year, but you're not staying in that home likely for a year. You're likely staying in that home for 10 years.
Yes.
And the average price of a home doubles roughly every 10 years.
Yeah.
And so you're going to come out on top by owning a home.
It shouldn't double in a year.
No.
It should double
like it
10.
has in the past.
It should double
It should
10.
not.
So we continue to have the strength, as Mike Frantoni was talking about the fact that we have this, and Goldman Sachs was talking about the fact that we have the strength in equity, we have the strength in the home buyer. Foreclosure starts are picking up. They're almost back to where they were pre-pandemic, because remember, we had a foreclosure moratorium. Yet those homes, that's foreclosure starts. So foreclosure starts are up, but the actual completed foreclosures is still extremely low. In fact, it's a third of what it was in 2019. So those numbers are remaining low because people have so much equity and have the ability simply to sell and don't need to go into foreclosure. We're not going to see these massive sales because we're going to see a high number of short sales and foreclosures. Colorado's doing really well. We're about halfway through the states. We're number 26 in rank. So we had a total of 1,100 file for foreclosure, but actually during the foreclosure rate. So we are, yes, it's 224% over third quarter 2021, but that's when we still had the foreclosure moratorium. So these numbers statewide are still extremely low. Mortgage credit availability remains extremely low. When we talk about creative loan products, I'm not talking about loaning to somebody who's leveraged to the hilt, has a credit score of 640, who really can't afford one home, yet I'm going to sell them 3 on a stated income, stated asset loan. I mean, we have very strict guidelines across the board that is going to, with that partner with the equity, continue to keep people in their homes. It's just going to keep people from selling their homes if they can't afford, with these higher interest rates, that $1,100 more in monthly payment based on just the interest rate alone. One good news is Social Security just went out. That was just announced this morning. Those who are on Social Security or about to go on Social Security, they just got a raise. Interesting stat. So it's noted every year at this time based on July, August, and September inflation. And so based on the inflation that we've just experienced over the last 3 months, those people who are retiring are getting the biggest raise that we've seen in 40 years, an 8.7% increase. So that helps all of our moms. It helps my mom,
Yeah,
for sure.
it does.
Yeah,
it does.
And it also helps with eligibility. We have a lot of people who are retiring, who are purchasing based on Social Security, pension, retirement, and our asset depletion loan. So I want to highlight this because this is different than the asset depletion loan that Fannie Mae and Freddie Mac allow, and what I had always had access to before. Because now at OneTrust, we actually have an asset depletion loan where we can take all your assets, whether it's retirement assets, liquid assets, whether it was a gift, whether it was inherited IRA, whether it's anything else, if it's sitting in cash, whatever that is, if it was Bitcoin and you just liquidated it, whatever those assets were before, it had to be work-related asset or retirement assets in order to be able to use them as income. Now we're going to take any kind of assets that you have. We're going to divide it by 120, which is huge because Fannie Mae divides it by 360. Freddie Mac divides it by 240. We're dividing it by 120. And what does that mean? So if I take $10,000, or if I take, say, not 10,000, if I take $1 million and if I divide it by 120 and have that lowest number denominator, that's going to give me the biggest income on a monthly basis. So I'm actually taking it on a 10-year spread instead of 20 or 30 like Freddie Mac and Fannie Mae, which allows me to qualify for more. Now this will be on a 5/6 arm, which is fixed for 5 years, and then it changes every 6 months after that. But this is a phenomenal product if you're looking to do something and not pull it out of the stocks or not pull it out of your retirement account right now, because if it's in your retirement account, you don't want to be withdrawing on down years. So we can still use that to qualify you to purchase a home. So now you've got a raise in Social Security, and I've got the asset depletion. Or I've had a lot of people that had money from some sort of gifted funds that we couldn't use, you know, just wait 2 months. I just need 2 months of bank statements, and then we can make that happen. All right, let's see if we have any questions today.
There were about 4 that popped up
At the bottom. Let's go. We'll start from the bottom up. How how do you think the money that was printed in the last 2 years is affecting inflation in the market? I mean, it's everything in the inflation market, right? I mean, when people feel wealthy, when they feel like they have a lot of cash, they were investing it in all the stocks and they were trying to get more of an income. I'm sorry, not more of an income, more of a wealth effect. They were feeling very wealthy. A lot of people had a lot of money and they were willing to go 50,000, 100,000, 200,000 over asking. They were willing to get the nice car, go on the trips, buy the things that they hadn't been able to afford. So a lot of that has to do with the fact that the last 2 years, and now the Fed is clawing it back, slowing down demand, allowing supply to catch up, which is going to equalize the market and allow inflation to come down. Would it make sense for a buyer to lock in a rate in a slight dip? And can they still use a 2-1 buy down after it being locked? And yes, they can. So a lot of times choosing the 2-1 buy down might have an impact on the lock because the secondary market looks at 2-1 buy downs differently because the investors know with 100% certainty that that buyer is likely going to refinance as soon as the rates drop at all. But they can take advantage of the dips. They can do the 2-1 buy down. They can do a seller credit. All of the things to help them be able to have more affordability in those homes. If the 10 years 3.99, how can we tell where the mortgage rates will be that day? So there are a couple of websites that will show mortgage rates. I can share, in fact, in the email that we blast out, I'll share every presentation where I show the 30-year fixed mortgage rate is on the Mortgage News Daily. You can Google that and see that, and that's an open website that's free. So you don't have to have a password or anything. And that'll kind of show you where they're tracking. As I said, the 1.65 to 1.8 is kind of a historical trend. We're seeing a wider spread right now because of the risk in the secondary market. Do you foresee any trouble for people who locked in low rates a few years back on an ARM and now readjusting to the new rates? The ARMs, I don't know why anybody would have done an ARM when the rates were as low as they were for the 30-year fixed. But those people that did, that were taking a gamble, I don't know what lender would have told them to do an ARM. Now, they did an ARM as rates were going up. Hopefully, they still have 5 years. I do believe that we're going to see rates come down. I don't think that we're going to see them come down dramatically next year. I think that they're going to start working their way down as inflation comes more in check. And so maybe you even refinance a couple times if you really need to make sure that you lock in that lower interest rate, depending on how much it drops. People will say, well, how much does it need to drop? I mean, that depends. It depends on how much your loan amount is, how much it affects your monthly budget, and if you can get that done. We are doing, and we'll be sending this out as well. We're extending, because when this started happening, we had like a 18-month, we'll refinance you with no lender costs. We're going to extend that out to the end of 2025. I think that we will have balanced by that point, just to make sure that we're waiving the lender fee to make sure that we're giving you guys the best situation for refinancing. Does the asset program work for commercial real estate buildings? We do have commercial loans, so that we have lot loans, construction loans, commercial loans, SBA loans now, all of that. So we can definitely look at the commercial loans based on the rent or the business income that you would be receiving on that.
Still trying to wrap my head around what your report will look like in the spring when compared to 2022 when homes sold for 75K over asking and comps. I think that we are going to see a dip in the appreciation during the first few months of 2023. I don't think that we're going to be able to pull out some of those numbers again, just due to the market conditions that we saw back at the beginning of 2022. And so I think it's going to be a short-term dip that we're going to look at the beginning of 2023. I think that the backside of 2023 is going to look significantly different. It'll compare a lot better once we got to the point where we had the 6% interest rate again, but the beginning part of 2022 and 2023 aren't going to correlate very well. That's why I'm already starting to think about how am I going to put together my calculations for projections. And if I just chuck out 2020 and 2021
and go back to the
and go back to 2019. And so I think I might end up just going back to those markets so that I have a better comparison of what supply and demand look like at that point.
Why is the dollar so strong when there's so much money printing in the last 2 years? So, I mean, the dollar is, I'm not going to get into a whole dollar conversation because we're already at 11:03, but we can definitely talk about that in next Thursday's market update, a little bit of the strength of the dollar. Of course, it's globally affecting its comparison to the China market right now, which is struggling, the European market, which is fighting inflation on oil. Of course, Russia is still in the midst of a war. So you have a global effect that's also happening with the dollar. Where do you see rates at the start of the year? I think that they're still going to be volatile all the way up until the Fed decides to start pumping on the brakes. And they're right now estimating to go all the way up to 5% through February and March Fed rate meeting or Fed meetings, increasing the Fed rate.
What was the average interest rate last week? Seeing a lot of buy downs.
Yeah, we talked about that. That was
Yeah, we
right
did.
about that 6.75.
Yep.
Yeah,
We talked about that one. I think we got everything.
I think so.
Do you think the government may come out with some sort of first-time homebuyer program to help those that are still trying to buy and have been priced out by the rates?
They already have. They've started coming out with some programs. I know that Deerfield is an excellent program for those Black Americans. I know that the first-time home buyer, there's some additional programs that Freddie Mac is putting out. Really, it's just about, though, they all have income restrictions, which is really fantastic and will get you far in Oklahoma or Kansas, but it's not going to get you as far as in Denver. But we are starting to see that they are trying to do that. And I think a lot of that had to do with the fact that FHFA put in those additional costs to second homes and investment homes to try to pull back some of those purchases to allow for more first-time home buyers.
Awesome.
Yeah.
Well, that takes us through all of our questions.
Yes.
Thanks as always for joining us, and thanks for sticking around for a couple of extra minutes while we wrapped up all of the questions. Lots of great questions today. So thank you for your interaction. It always makes it much more interesting when we're not the only ones that are talking.
Yes.
So thank you for asking those questions.
Yes.
We sincerely hope that we're able to help you better advise your buyers and sellers. And we hope that if you're able to help you better advise your buyers and sellers, that in turn that we'll have the opportunity to offer them loan products and close them at First American Title and at One Trust Mortgage. So please feel free to reach out to us if there's anything that we can do. Otherwise, we'll be back at it next week. We'll see you next Thursday at 10. Have a great weekend.